Good evening to everyone, and welcome to the spring event for the Georgetown Club of France's spring event, indeed on the topic of sustainable finance. My name is William Holmberg, and I'm one of the leaders of the Georgetown Club of France here tonight. Today we have, of course, an audience in Paris. We also have a number of people who are connecting online, and we're able to listen to this, and you'll also be able to download it later on. We are recording this event. So thank you, not only Georgetown alum who are connecting, but also alumni from other US university clubs in Paris. Indeed, we have three distinguished panelists to speak on the topic of sustainable finance. We have the perspective, of course, from a leader in a ratings agency, one from the perspective of the World Bank, IFC, so therefore investing in private markets from that perspective, and last but not least, from a global asset manager, Allianz Global Investors. I would encourage, although we can certainly not necessarily respect this rule, but I would encourage you to hold questions until the end. But if we come up with certain topics where it makes sense to switch to debate, we certainly can do that as well, naturally. I would like to thank Pascal, who is absent from this room at the moment, but he's indeed the gentleman who made this room available to us as a principal at Denton's. Last but not least, I wanted to, once again, encourage you. Suggest that the best way to begin this debate and discussion on sustainable finance is to define it. What is it? Secondly, ask the questions, can it be measured? If so, what's the best way to measure it? So we're going to begin first with a few comments on what is sustainable finance, how can it be measured in public markets, in private markets, and also compare and contrast that to what that means in impact investing as well. So with that, I will turn the microphone literally over to our first speaker, and I'll ask him to introduce himself, Thomas, in order. If I can just introduce yourself, and then of course the lead director, Ali, who will make comments on the first topic, which is indeed defining sustainable finance. So with that, can you introduce yourself?
Good evening, everyone. I'm Thomas Roulin. I'm heading the sustainability methodologies and analytics teams in Allianz Global Investors, which is a global asset manager. We are managing assets in all the spectrum of asset classes, equity, fixed income, alternative, multi-assets. And as such, my team is in charge of ESG integration across those asset classes and also methodologies for sustainable finance.
Thank you, Thomas. So I'm Thomas Pellerin. I work for IFC, which is part of the World Bank Group. So for those who don't know, IFC is a leading international organization, financial institution that invests in the private sector and emerging markets. And I lead the business with European sponsors investing in those markets, specifically in industrial and services with specific focus on retail, property, health, education, manufacturing.
Yes, this microphone works as well. Hello, good evening, everyone. I'm Elie Arrière-Dubreuil, the CEO of AT Finance. AT Finance is a rating agency, both as a credit rating agency, operating in mostly France and Spain today, but also as an ESG, and we'll come back to that later, as a sustainability rating agency, and we also offer related consulting services. And without further ado, I will start by a short definition. I may state the obvious for those of you who are already familiar with what is sustainable investing, or what is sustainable finance in general. It is taking into account when performing as an investor allocation in its portfolio or a selection of products, basically any products. It is taking into account the environmental, social, and governance factors. So the acronym known as ESG. From the point of view of the investor, if you are working more with issuers, you may have heard the acronym of CSR, corporate and social responsibility. Those are basically the two faces of the same coin. But for investors, we typically refer to the dimensions of risk. Environmental, those can be climate change. It could be transition risk. It could be physical risk that can arise from floods or fires or heat waves or others. It could be social factors, whether from inequalities, and it could be from within a company or outside of the company, the impact of the company on its environment as well. Sometimes people distinguish, this is what we do, for example, at ET Finance, the S dimension between the social and the societal impact. So within the company and outside of the company. And the third dimension is governance. And governance is, of course, proper governance of the institutions, the companies, the corporates, but also the environment they operate in, the institutions, respect of the rule of law, and other factors that may be conducive to good business. ESG can be viewed as risks, but also as opportunities. And I will just conclude by saying that essentially sustainable investing or sustainable financing, at least I am convinced of that today, any investor cannot but look at these factors when they make investment decisions, and therefore sustainable investing is becoming investing. That's it.
Sorry, so I will continue in with the way we can measure all these factors. So I think that we need to refer from a general perspective as an asset manager level to what Heli has mentioned some of those factors, whether it is related to climate change, social and governance, and how. So there is a lot of methodologies. I will mention some of them, like the standard ESG ratings. We might also use some key performance indicators. We might also refer to the exposure to certain sectors which are not sustainable. We can also refer to the product and services. And the third step will be to decide and define at which level do we measure and all those factors, whether it is at an initial level. From an asset manager perspective, it makes a lot of sense, but also from a fund, a portfolio level, from an, let's say, a more global picture from an asset manager point of view, let's say, collecting and gathering all the data we need also to aggregate at portfolio level and ultimately to all our assets under management, because there is a lot of initiative now looking at all the assets which are covered now. And we can also mention the way we might measure the various asset classes. We are referring a lot to listed assets, but we might also mention the impact on the alternatives and the private markets, because here we have more transparency to the projects we are financing compared to the listed asset, where sometimes we are leaking information, which is scarce information, always relying on public available disclosure, which is not always reliable or let's say, yeah, fully transparent. Something I didn't mention is also another tools, which is the controversies. Here we are looking at the various incidents on all of those factors, whether it is ES or Gs, and their severity across times. So we all have in mind some big incidents like the BP1 with the oil. So this one, we have the other one with Volkswagen, for example. So those are the big incidents which have a high severity for the investors on the price of the share directly. So we have a lot of methodology, as many as investors have, and we are also partnering a lot with agencies and rating providers to assess all those factors.
So if I take it from where you left it, Thomas, Allianz and other asset managers essentially have the whole universe of asset classes to invest and provide returns to their clients. And they've decided to focus on ESG finance and ESG criteria for various reasons, societal, but also improve returns in many respects. The institution I work for, IFC, is a little bit different. I mean, we were created for a specific purpose, which has evolved over time. And originally, when it was created, it was essentially promoting, economic development in developing countries through the private sector. Over time, our shareholders have been asking more and more from us, including environmental ESG compliance. So we came up with a whole ENS, we came up with all ENS standards in emerging markets because they were none, or actually the ones that were in emerging markets were really weak. Over time, again, and then we started also to look at impact. But at the beginning, like when I joined 14 years ago at IFC, impact was described in a note to our board in a very qualitative manner. More recently, we started to develop methodologies how to assess impact. And impact for me is a little bit the upside in all the ESG space. So you need to come up with a number of environmental and social aspects, and you need to be compliant. It's kind of compliance space, so you need to meet that. But impact is anything above that. So within that space, you have several kinds of impact investors. You have very niche focused asset managers that will have maybe also very patient investors, even investors that may not seek a high return or may not seek a return at all, actually would be happy, or not happy, but certainly patient to have a loss on their return because they feel that it's super high impact. IFC is not really in that vein. What we do is that for everything we do, we don't measure the impact. And that impact can be excellent. It can just be good. It can just be satisfactory. I mean, we have a whole scale. But we still do deals or transactions that support businesses that don't have say just a satisfactory impact. But we do it for other reasons. It could be because it's in a sector that really needs support. It could be because it's in a country where it's important to do deals, more meeting this development agenda. So that gives you a bit of a picture that in that space, you have different type of actors for whom impact has a very degree of importance. For IFC, it's one of the many aspects that we look at. For others, it's just 100% what they look at. And for which the measures are going to be also different. And today, I mean, I think we see a lot of asset managers coming with their own methodologies of impact. So at some point, also, we're going to have some sort of a convergence, I think, into how to measure those impacts, which is a bit like, I think, quite widespread. And you must see that on your side.
So speakers, thank you so much for those great introductory remarks. Indeed, we've now defined sustainable finance. We have a good idea of how to measure it. We've heard these words ES and G. We might be asking ourselves, how is that interesting, either from the context of how our portfolio is managed, your portfolio, your retirement money, or that of others? And secondly, does this affect the real economy? If I look out the window, how is ES and G affecting the decision whether or not to have French wood that's coming from the Southwest shipped off to China to be chopped up because it's cheaper to do there and then brought back and sold in final form here? These are real economy questions and portfolio questions. So I thought maybe to the speakers now, think about first and foremost how ESG can be relevant to a portfolio. Imagine you're looking at a fact sheet or your quarterly statement. How is ESG actually visible to you from the point of view of the investments that your investment managers make? And then secondly, a couple of examples of real world choices. So for Thomas from IFC, he's certainly going to be thinking with a private markets hat in terms of the choices he has to make. For a ratings agency, it'd be interesting to hear your perspective on this, real economy, as well as, of course, in actual portfolios, your clients' portfolios. And last but not least, for a global asset manager. ESG from the point of view of impact on portfolios and then in the real economy.
Okay. So we don't really see it from a portfolio basis because, I mean, I think at the end of the day, our mission is definitely for impact. It's just varying degrees. We want to, of course, now that it's quantified, we want to, of course, have an average portfolio with that has a high scoring. But at the end of the day, as I said, there's just multiple demands made on institutions like IFC, including, where you put your money, putting money in some of the least developed countries where you may not have the through the measurement process, not the highest impact, but you have to do it also politically, because it's part of our development agenda. So overall, on the portfolio, it's also something very new. So we look at, of course, like credit risk in our portfolio, or equity risk in our equity investment portfolio. We also look at the impact and the ESG compliance, but and then from time to time we also try to look at the correlations between all of these, which is I know that the asset managers in public listed assets spend a lot of time to do, and you see usually articles about every 2 months in the FT about this. For us, we try to do it, but our portfolio is essentially private debt, private equity, and it's not as simple to do.
Maybe to bring a little bit of the perspective of the rating agency, trying to measure that into the metrics that we provide to our clients. I think it's interesting to spend a minute onto the concept of double materiality. This is a concept that emerged a few years ago in Europe to try to classify the types of ESG materiality that can arise. And essentially double, because the first is the impact of the environment, social and governance factors onto the company. And that can also be understood as a financial materiality, because ultimately it will impact the financial figures of the company, and therefore its credit risk or its equity risk, depending on whether as an investor you're lending or investing in a credit product, or investing in equity as a shareholder. And also looking at impact materiality, which is the impact of the company or the entity that you're looking at onto its environment, onto its stakeholders, and that in turn can also come back and have some financial materiality that we should not forget. If a company may be polluting, maybe going unnoticed for some years, at one point this may be realized. This may result into a controversy that Thomas was mentioning earlier, a reputational risk, maybe a direct fine from the regulator, or the clients turning away from the company, and therefore a financial loss. But the first impact, and looking at how ESG can impact the financial standing or the credit worthiness of the company. I'm going to take the point of credit ratings here for a minute, as we are a sustainability rating agency, but also a credit rating agency. So in our credit rating methodologies, we try to incorporate as much ESG factors as we can. Not only, but this is not out of a statement of saying we want to have more impact. We're not a development financial institution. We don't have we're just trying to get to the best rating. and the best rating being the best prediction of the risk of default for a company. And ESG factors are actually a way to anticipate many of the financial risks. So it is a wonderful opportunity today for investors to have at their disposal, their availability, not only the audited financial statements, but also a number of additional new information onto the company that they can incorporate into their analysis. So this is what we're trying to do, and not everything is material. I'm going to take one example on sovereign ratings. Because this is visible and usually people understand, even if you're not macroeconomists. You can. We've tried to do correlations, as Thomas was mentioning, between ESG and credit factors. And one area was whether a country applies or does not apply the death penalty. Has absolutely no correlation to the credit standing. So if you want to look at it from a point of view of the financial materiality in your credit rating methodology, if the only thing that matters to you is the financial risk, then you shouldn't look at whether a country applies or does not apply the death penalty when you're making your investment decision. But then if you want to look at it from the point of view of impact investing, of ethical investing, then this may be a factor you may want to look at. This is just an example, but maybe I will let Thomas speak more about this from the point of view of the investor.
Thank you, Eli. So this is not an easy question that reconciliates sustainable investing from portfolio, retirement portfolio with real world. So I will try to answer it with 3 key dimensions. The first one to me is that integrating ESG is risk mitigation. It's a link to the long-term value creation for your portfolio. So it comes from the non-exposure to non-sustainable business, because even if it is still profitable over the short term, over the long term, it will create loss in your portfolios. It might be also to look as the risk-adjusted return. So we are not looking at maximizing the return, but to have a high return given all risk, including those new risks. We might have in mind all the risks related to physical climate change, or also to the regulatory pressure on carbon emissions. So I would classify these first dimensions, which is related to risk mitigation, even more when we are looking for long-term investment for our retirement. The second dimension would be related to the growth potential that is related to ESG. When we are looking at integrating ESG, it's not only about risk, it's also about the complete reallocation of the capital and the flows to a new business model. So we need new decarbonization technology and we need to finance them, right? So it means that we are now need to, as an asset manager, to invest on the best players of our investment universe, but also on the new unicorn over the market, which are providing products and services helping to mitigate all those risks. And there is a huge growth potential in that dimension. And that's why it might truly reflect something in the real world, because we will participate to that growth by investing on the right issues. And my third key dimension will be related to the stewardship. Because we are steward of capital, at some point we are participating to that transition. So everyone is thinking about the climate transition, but not only. Also the transition when it comes to social and governance aspects. So one example is related to the proxy voting. As an equity owner, we are exercising our votes. So it means that we can support some resolution from governments or boards, but we can also reject some of them. So we might also influence them through our continuous engagement, asking to have a more diverse boards, for instance, which is a social dimension. We might ask to have more ESG objective for the boards and etc. This is a way we can also improve and participate to the transition to a more sustainable future. So these are the three key dimensions to me.
Thank you, panelists. So a few ideas come to mind based on what you just shared there. The notion of divergence in ratings when it comes to ESG criteria. In other words, I happen to work for an asset manager, and it's indeed remarkable where if you look at L'Oreal or IBM, that indeed across the different ratings agencies, you can see today, across a broad spectrum of companies, regardless of the industry, different ratings. Some may be good, some may be poor. What is your prognostic or view on if there could be convergence over the long term? Is that a good thing, or is it healthy for, in fact, there to be a wide dispersion? It just makes it much more difficult for the consumers of those data to determine which one's the right one and which one's the wrong one.
Difficult question. Of course, our ratings are the right ones. But the difficulty is really what you're trying to measure. You're trying to measure a series of risks. So one way to have some convergence is through what I was referring to earlier as financial materiality. Because there, essentially, the metric is trying to predict the financial impact, and be it credit or be it impact onto the equity price. You can measure that impact, and you can see a posteriori, you can verify, you can backtest who was right and who was not right. So through the incorporation of ESG into credit metrics or into equity metrics, then you have an opportunity there to have an objective view of the predictions and of the ratings which are going to be made. But as I was saying earlier, ESG ratings, even though some people that would be convenient for some investors and some market participants to say, well, then let's stop there. If it's not financially material, then who cares? And because it's what is financially material, we can measure and we can see together if who was right, who was wrong, who was the right analyst onto this company. We can have some form of convergence, but this is only part of the equation. And I'm sure Thomas, but even more Thomas would comment that they're not only interested in the financial performance of their investments. This was explained to us earlier, and therefore they're trying to measure something else. And the IFC has their own methodology to measure what is impact to them, and others will have other methodologies. So, and it is normal to see some of that divergence. So I'm not sure that we will ever fully converge onto general ESG metrics, because different investors will want to measure what is important to them, which will not necessarily be the same thing as the other investor from an ESG perspective. What is important, though, is that we speak a common language, that we have common standards. And the UN has helped a lot with sustainable development goals that can be used as a common language to talk about some of these issues. There are a lot of developments on biodiversity these days. That there are also standards that are being developed to say, well, how can we classify, and at least we speak a common language. But not everybody from an investor's perspective will have the same goals. And I think we have probably two different examples here, so I'd be interested in hearing their views on that.
I love that question because every time I see an institutional client, I have that question. What do you think about the divergence in rating? My answer is I like it. So why? So from an asset manager perspective, it means that there is value in divergence. Otherwise, we will have an efficient market. If the rating is supposed to be at its place, the market share and the market price is at his price, right? So I like the divergence. because there it means that we need to analyze why there is a divergence, what are the drivers affecting the divergence, and is there any opportunity or risk behind that divergence. I also don't believe that at the end um, we will have like a single framework and a standard on ESG because it's relying on some convictions. So anyone has different conviction from the other. And it is the same for the rating agencies. Some are looking at purely risk, others at disclosure, others at the momentums, while some agencies are looking at the position, the current position. We are also talking a lot about the double materiality, the handprint, the footprint. So what is the handprint of the company without looking at what are the products and services. So we might think about the tobacco sector, for instance, which have a huge, beautiful footprint. But when we look at the products and services, they are not sustainable, right? So we need to consider a lot of aspects. And this is also where we are expecting from an asset manager to give you more transparency and information about why we are basing our investment decision. I would say that from an investor and point of view, sustainable investment is increasing transparency to me from my investment, which is good.
I I don't have much to add to this because obviously we function in kind of a closed circle where we choose that we have a mandate and we do find transactions that fit this mandate. If they don't, I mean, this is it. So that's a bit different. But if I may, I would like to bring the conversation to another level, which is the level of what's happening underneath this sustainable finance frame, and which is like the companies are being financed. So and there I think there's and one question that I would like to get to is that if you were to put some of your money somewhere that you would like it to be sustainable, I mean, how sustainable is this, right? And so pressing on pause and looking backward, how companies have reacted to that. So I've been facing European clients for many years now. If you look at 15 years ago, you talked about sustainability, people will come to you and say, hey, look, I mean, this is the pictures of the orphanage that we're financing in country Y. Isn't this great? Great. But for instance, us at IFC, we're going to tell them, listen, this is not what we're looking for. What we're looking for is for you to look at your own operations. And the way that your operations are run needs to be sustainably run. And that has, I mean, a change that has evolved over time from being a pure philanthropy / CSR type of aspect, usually managed by communications people. Actually, you meet a company, you immediately know how committed they are. If it's a communications person that runs the shop, and no offense to them, you probably do, some of you are in the room and you're doing a fantastic job, but they don't have their heart in the right place. When you see that, I mean, especially you've been a major change in climate following the Paris agreements. Major corporates in Europe have started to take this problem and say, okay, we need to do something. And they started to staff these functions with their engineers, right? Okay, we need people from the operation that are able to understand how is it that they don't start to drop GHG emissions, that understands the nitty-gritty of changing that landscape and having and setting those goals and moving with them. And how is it that the business is going to have to change? And I think, especially in the industrial sector, manufacturing, you see that change, and that has been tremendous. Now, today we see a lot of back to the product. We see a lot of sustainable products. So let's say green bonds, which I'm sure you're rating, social bonds, all these are, I'm sure you're invested in. And if you look at just on the debt side, also sustainably linked financing. So basically some type of instruments where the remuneration of the instrument is going to be linked to a key performance indicators on sustainability. And if essentially an issuer or company has a positive exceeds, say, certain KPIs, then their pricing will be lower. And if they do not exceed but actually perform below expectation, then they'll pay higher. So you see a lot of type of tools that's been out there. but at the end of the day, I'm not too sure that it does answer the question yet. Like if I buy a product from this company, is my money where my heart should be? Let me give you an example. There's a major senior tier operator from France that did issue a number of green bonds and social bonds. Now, with the scandal that happened about 2 months ago in the senior tier sector in France, having bought that green bonds, which went into essentially a green bond in that case would be the use of proceeds would go for a building that's been green certified. In turn, has a very low GHG emissions in its the way it's considered in the building itself, the materials, GHG. Sorry, the electricity consumption during the life of the project, etc. So you buy this asset. Are you sure that your money is in the right place? Well, it probably is, because that building is certainly like energy efficient and has low GHG emissions. But does the company is doing the right thing? Well, you probably thought they were doing the right thing, but at the end of the day, you see those channels that arise and they're, man. So that's what we see today is the following, is that I think a number of companies are taking their low hanging fruits and seeing that the market is developing with interesting products, going with what they can do the easiest, issuing, putting a number of like sustainable finance instrument out there. And today in Europe, I mean, about every major blue chip company has its own sustainable finance framework. Not so much in the US, although it's picking up. But I mean, you can definitely, I mean, be sure that in Europe it's the case. But then you have some more fundamental questions that come to mind, and that's I think where you guys have some crucial dilemmas to deal with.
So sorry, if I can just pick on this, it's. I do agree with you. I mean, part of the issue of the green bonds, for which still we have to be grateful to the international, supranational institutions for starting that market many years ago. But was that basically the use of proceeds was ring fenced, and indeed you could finance, you could be a tobacco company or fossil fuel and issue green bonds to finance your green building. I think though something that is happening in the market, it's only the beginning, is an interesting development, is sustainability linked issues. You did mention that earlier in passing, in saying that those are issues in which the remuneration for the investor is linked to the realization of a certain key performance indicator that is sustainability linked. Now, I'm saying it's only the beginning, because at the moment, typically the change in the coupon is going to be very small. Whether the indicator is achieved or not is going to be basis points difference, maybe 20 basis points, but it's not going to be a big game changer. But I think this is still the beginning of something interesting, because there you could look at the overall performance from an ESG point of view, or from an impact investing point of view, or from the things that matters to you as an investor, in deciding to say, I'm going to have an impact by investing in this company that has promised to achieve this indicator. And if they don't achieve it, essentially they'll pay me more out of it, which is, you could say, part of the risk premium of not achieving that for the investor. So it's only the beginning. I don't think the market has the right pricing for how this impact really should be, but it is an interesting development.
It is. So if I would like to add on this. So of course, you pointed to one of the weaknesses of those type of financing. If you look at some, I mean, they are going to issue this type of instrument, but actually not use them. So not only it's very the change would be very minor. I mean, we say 20 bips and not even. I mean, 5 bips in many of those. And if these are, revolving credit facility types, I mean, sometimes they're not even used. So, I mean, it's completely meaningless. And it's a lot of, so you have a nice sustainability linked loan finance on your, out there on your website and whatnot, but actually you're not using it. So it's not meaningful. And even the 5 bits would be so meaningless for a number of those companies if you look compared to the bottom line, even just the financial bottom line of the company. I want to take this to give an example on how sustainable finance can be a key part to changing landscape in an industry. So many years ago, there was a building collapse in Bangladesh called the Rana Plaza, and we found many brands from very reputable big brands in Europe that were found in that building, and that completely has shaken up the textile garment sector. So at IFC, we try to find solutions to, okay, what is it that we can change here? And of course, it's a sector problem. To keep it simple, you have like a big garment or brands that do a contract manufacturing of their clothes, and they don't own the factories. It's a contract, and then that entity, they actually subcontracts, to which eventually subcontracts, and in a lot of it is in Asia, but not only. And there are poor labor conditions, but also poor building conditions that they work in. So the question is then, how do you change that, right? So we did a number of things, but one product that we brought in, which was a supply chain finance product, where basically the pricing of the so basically you do a reverse factoring, so which in simple terms allows one of those factories, instead of being paid 90 days later, they can be paid at 3 days, but they get paid a little bit less. Okay. Now that little bit less is a factor, an interest rate, which would then be dependent on their ranking on ESG standards. So we did that first deal with Levi's in 2014, where actually we put a scale. Levi's has his own scale of, I think, 1 to 10, or gold, silver, platinum, or whatever, for ranking their own suppliers on like ESG, especially social, labor, but also environmental standards. And with that scale, you give a pricing. And if you improve in the scale, your pricing on the discount for this money is going to reduce. Does that solve the problem? No, that doesn't solve the problem. But when the brands talk to their suppliers who don't really want to also put any investments into upgrading their facilities and etc., and frankly, the brands don't give them much more support on that. Having these type of tools is one of the 3 or 4 tools that you can put together to eventually make a virtuous circle that will lead to some changes in this supply chain, which eventually, I mean, to a certain extent, maybe not the greatest extent as we would like to, but has happened in the textile sector. So anyway, that's just like a practical example of I would say, sustainable finance product that did have a direct impact in solving a global problem, but at a micro level.
Well, thank you, Tomax. I think that transitions perfectly to the last topic I wanted to evoke before we switch to Q&A, to, of course, our participants online and those in the room, which is indeed this notion that we kind of want sometimes companies to respond to us. That means indeed to respond to what we call engagement, or in fact, the fact that we want change in the real economy. I happen to work for an asset manager right now. We're asking in 2022, and the price of oil skyrocketed, and a number of oil companies say, we really want to demonstrate on our beautiful corporate responsibility document that we are engaging net zero 2050. How do you reconcile that with massively increasing your CapEx in building brand new oil and gas facilities. There are countless examples that these gentlemen can give as well. So maybe it's a last topic before we go to Q&A. How do we reconcile and do more engagement, which is a fancy way of saying, how do we either individually or collectively get corporates, whether it's in small emerging markets or right around the corner at large MNCs in Paris, to improve their KPIs on ESG, or translation, be better stewards of capital and leave the world in a better place at the same time. So hopefully that'll be the last topic here for over a few minutes. We're right on schedule, and then we'll switch to Q&A.
Shall I start? Okay. So how do we close the gap between those commitment and the true engagement from the company? The key to me is the key performance indicators that we are monitoring following those commitments. Over the last years, we have seen a lot of commitments, but now we are putting in place all the methodology to monitor those commitments. Ultimately, they will have, let's say, we will have two outcomes. One, they are truly decarbonizing their commitment and they are following their commitment and decarbonizing their footprint. Or the other one is a controversy, which will impact their intangible asset, meaning the reputation, but also their tangible assets, because no one would like to participate or to invest to companies which are now bad players in the universe, recognized as committed, but failing to follow those commitments. So the key performance indicators are key, specifically on the carbon dimension, because now we have some kind of standards when it comes to carbon intensity. We are able to measure it. What we are still missing is a time, let's say, to resolve the timeliness of those information, because they are quite backward looking and sometimes outdated for a year. We are also missing some audited data. We are just relying on reported data. So science will help us to reinforce those methodologies. We will also expect some rating agencies to participate to the, let's say, the meaningfulness of those reported information, because we are also using some proxy information, simulated data, to make sure that what is reported is consistent with their production, for instance, their product and services. And the more and more rating agencies will be able to tell us that the information is consistent with their commitment, and the more we will be in line with those.
So I mean, so that's interesting. So unlike asset managers of the size of Allianz, etc., we really interact in a private space. So we have direct, I would say, agreements with the companies we invest in. So we are able to, through these agreements, derive the level of engagement that we'd like to have, ideally. So practically, what does that mean? I mean, IFC goes in before any investment with a very thorough, comprehensive due diligence on all aspects, and many actually European companies are not prepared to that. And for the use of proceeds that we're going to finance, we're going to look at all ESG development impact aspects. And we're going to ask some reporting on it on a yearly basis. We're going to ask, you know, to that a number of things are happening, and also reporting on indicators which we will collect, analyze, and aggregate, etc. So now I think on the engagement, the key question in the engagement for us is when things go wrong, right? So, and they can go wrong mildly, which is okay. It's not wrong. And then you can have the scandals, right? And as much as we've done this very thorough due diligence up front, making sure that things are well checked. I mean, we still, with the sheer number of investment that we make every year, we still run, I mean, by the law of statistics, into some major problems that turn out to be scandals. And certainly engagement during scandals is really not, it's too late. I mean, you don't have, I mean, people react, don't know how to react. 90% of big, small, medium companies don't really know how to react. It's only after really bad blood has happened that they start to realize that they should have behaved differently and start to engage. And that's been our experience. So for us, there's it's always a bit critical because there are things that are just not acceptable from being an international financial institution that is owned by governments, etc., that hold us to the higher standards. But in any case, we always try to be find a way to help these companies find a remedy. And that can be linked to, I mean, various problems. I mean, we invest in so many sectors. But we try to be there and engage with them and help them find the solutions. Because at the end of the day, I mean, the naming and shaming has its benefit, has its virtues. But if we want to make the whole thing, I mean, the whole business move is going to have to be through engagement and feedback and finding solutions to come up with better business models. Because one thing you can be sure is that when a company has had a major scandal, the next time they will make an investment, they will factor that in. And those things happen because, I mean, maybe we didn't do a good job at due diligence, but there are also new problems showing up, you know, that we never factored in. That's why actually our performance standards, environmental and social standards keep on being like refined over time, because there's just new things also, new type of problems arising.
I think I'm going to probably summarize and repeat a lot of what has been said. Engagement starts with having good data. This is a lot of what we do, and this is a lot of what these guys do as well, I guess. But it starts with trying to collect the right indicators, trying to check them. We spend a lot of time interacting with the issuers, with the companies to try to. Our work is not that of an auditor, so we're not going to go and check, you know, if the company is telling us my CO2 emissions or greenhouse gas CO2 equivalent is that many billions tons. We're not going to go and check whether this is the exact number, and but we're going to try to see whether it's consistent, whether it is comprehensive, whether it has covered, well, now most listed companies would cover scope 1, scope 2, but scope 3, which is what happens before and after, is not necessarily measured in a consistent way by companies. So we're trying to go and understand and complete that data, maybe simulate it, estimate it, being able to benchmark and to qualify the quality of the data. So it starts with good data. And then the next step in terms of measure is also trying to react to the unknowns, to the uncertainty. This is what has been mentioned as scandals by Thomas and controversies over there, but this is basically trying to measure the same thing. Earlier, Thomas was mentioning about this social care who was hit by a big scandal earlier this year. We had a controversy rating onto this company. We had downgraded them from 3 to 4 on a scale of 1 to 5, so going to high risk of controversy last October. Not sure whether you're a client of that product, Thomas, but so we had identified a high risk of controversy. It doesn't necessarily mean it is going to materialize, but there were signs that something might happen. But once you've identified the risk, what do? You're trying to engage. So Thomas has described that they have very rigorous methodology, but I'm going to add something, which is what happens if you're a relatively small investor. You own only 0.something% in the company as a medium size or small size asset manager, what really can you do about it? I mean, yes, you could through proxy voting vote on the recommendations if it's a listed company on the general assemblies and try to reject some of the recommendations. But frankly, if you're 0 point something percent, the company is not going to care much. So what you can do is try to do collective engagement. So find other investors who may share the same concerns or the same impact objectives as you do. Let's take one example, biodiversity footprint. You may be concerned that some companies you have invested in cement or construction may not be doing enough to tackle those issues. So there you have an opportunity as a rating agency, as an intermediary, can we engage into collective engagement. So so we can group a number of investors. And then together they may represent 5% or even more of the capital, and then it starts to matter for the issuer. Then they will start to listen to what you may have to say. So this is just one additional tool, because not everybody is going to have the same quality of dialogue that that you can have directly with the investors. Thank you very much. I think we can now turn over to questions.
Exactly. So if anyone has questions, just so that the audience listening in can also hear you.
Thank you, gentlemen, for this theoretical framework. I like concrete examples, and I was hoping that you could rate and analyze a company like Amazon.
Well, they're not part of our rated universe, so I will. You know, we rate 2,300 companies publicly, thousands of private companies as well, but they're not part. So I don't have I don't have a direct opinion on them.
Just in general, how would you rate Amazon in terms of ESG? You know, a lot of people consider Amazon absolutely great investment and kick themselves that they didn't invest 10 years, 15 years ago.
Well, yes. Well, you know, even if there may be a correlation between ESG and financial performance, it's not certainly not 100% correlation. You know, and if you wanted to make money over the last year, you should have invested in oil, fossil fuels, you know, and probably weapons as well. At least over the last few months. So this doesn't necessarily mean from an ESG point of view it's a good investment. Now I don't know, as that we're not analyzing the company, but from just let's say public knowledge perspective, we're going in our methodology. We're trying to look at the CSR maturity of the company. You know, we were saying earlier, everybody is looking at it from a slightly different angle. Investors will have their own methodologies. From our point of view as a rating agency, we're trying to look at the maturity of the company compared to peers, compared to others. If we were doing an impact rating, that would be slightly different. It's not necessarily but we're going to look at whether they are trying to reduce their carbon footprint, and if they are trying to, let's say, increase short-term deliveries, as they have been doing over the recent years, now offering fresh deliveries in a matter of hours. Well, what it means increasing logistics. So you don't need to do a lot of math to say this means increasing footprint. So unless everybody is on a bike delivering, which maybe can happen in very dense urban centers, but it's not going to work on a nationwide or worldwide basis. It means you're going to increase your carbon footprint just by trying to provide a better service to your clients. It has a consequence from an environmental point of view. Social point of view, I guess I'm not going to comment much. Maybe the workers at Amazon will succeed in unionizing themselves. This is still up for. Well, it precedent was set. Yes, but I think Amazon is appealing against it's not sure it's fully done yet. Though not following what is going on. From a governance point of view, though, there I don't know the company. If it was Tesla, I could tell you governance is not great, but which can be another great investment from a pure investment point of view. But and Tesla is actually one of these poster child example of the difference. But maybe I should let Thomas, I'm sure he has some exposure to Tesla, answer.
So I can give you a few words on Amazon. Yes, first. Let's start with Amazon. So I'm not an analyst per se of the IT sector, but what I can tell you is what is important for such a sector is the data privacy questions. Okay, and when we are looking at sectors, we are looking at the most meaningful and impactful factors. When we look at Amazon, we have also another issue because it's now a conglomerate. It's not only a retailer or a business which is only delivering goods. It's also related to web services, broadcasting, communication. So now assessing Amazon is tricky, not due to that size, but due to the variety of business activities, because all of them have different factors to consider. So if we look at the retailer business activities, yes, we will look at the carbon intensity of the delivering services. When we look at the web services, we'll look at the carbon efficiency of those cloud center or cloud data center. And if we look at the broadcasting, we'll look at the social consideration and etc. So my answer is quite complex given the size and given all the activities. But to me, when we look at the tech sector, first we should look at data privacy. I don't have a rating in my pocket right now, but I can look in my database. I know that you have some rating. Knowing the union, I think you will upgrade the rating now on the social dimension. I hope I answered your point as much as I can.
In the interest of time, I propose maybe 2 more questions max, since we're coming close to 1 hour. Anyone else? 1 and 2, please.
Yeah. Hi. Sorry, I have a very quick question. I want to jump back on what you were saying on the best investment in the last couple of months should have been, for example, I don't know, like investing in oil companies or this kind of companies that have ESG problems, we might say. I have a trouble to understand how, in the end, investors want return on their money. And how do you make sure that ESG is not just a niche that makes big investors feel good and like publish that, okay, we've invested a bit in a portfolio that has like a good ESG rating, but it actually changes finance. And I'm a bit skeptical, especially because I have not heard you talking about China, India, countries that are now taking like a big chunk of the world's GDP. And I doubt that they have the same ESG commitment as the markets in Europe or in the US. So it's not a question, but it's what's your perspective on this? Maybe.
Yes, I'm not going to answer that question. I'm just saying this is for Thomas. His biggest exposure
Probably
is
yes.
India.
So listen, several things. So far, when it comes to IFC, wherever we do, we apply the same standards. We have one same standard, and this is what we look at, right? So on the discrete projects that we're going to be financing or equity position we rotate is going to be the same standard, right? Now and we are a micro institution, right? The bench or IMF are more macro institutions. Um, but we are also trying to engage with governments on more, broader type of reform. So, for instance, if you look at ESG, I remember IFC setting up training programs with Chinese banks on those issues. I can tell you that, for instance, in green building, so IFC created its own green building standard for emerging markets, which is more adapted to emerging markets. And we also helped set up green building councils in many countries, work with them on trying to define what should be your green buildings. So those, it's true that the level of regulation today in Europe is not the same, is much more advanced than in many countries that are emitters, but it's not only China or India, it's also in the US and the large, including the large emerging market economies. But the thing is, at the end of the day, what we see is that the path is the same. So they may be on a different variant, but we're all on the same train. And I think that is the main point. And if you look at, and because the Chinese will eventually, we can already see they will invest into green businesses, green technologies, and they are doing this already. They have strategic interests, so they have just tons of coal, and they will keep on using that coal because it's cheap, and they have to. From a strategic perspective, it would be hard to say no, and they don't have the moral high ground to say no. But eventually, it's coming, and we see it everywhere. And some of the industries which are extremely globalized in emerging markets, you see that pressure is there, and the interest of sustainable finance actually is really high in emerging markets. For many reasons. One is that there's maybe into business with more regulated counterparts. So, for instance, selling to Europe. They may have investors also from who are more sustainably minded. If you like at economies like Brazil or maybe not India, but large great economies, they do have lots of in Latin America, they have lots of American investors. You do have a lot of asset managers put their money into emerging markets, and they are pushing also this agenda in the same way, especially with the big guys, right? So overall, I think there's the trend is there, and before it used to be, when it comes to these economies, it used to be some, specific type of investors like IFC coming in with certain criteria. But we see, a snowballing effect through the various, ways that I mentioned.
Yeah, because you are looking for concrete examples, if I understand it correctly. So I think it's not a niche, definitely not. It's becoming mainstream and global. I have one simple example, which I took from my kids. There is no more plastic straw in the Happy Meal. This is not a European company, right? The future EV market in terms of size, it will be China. This is where Tesla has built his second factory, not in Europe. So we need to consider something with China and India. They have a strong growth, right? And they are taking into account the new technology which is offered to them, right? And they are quite reactive. They need energy, so they are continuing to build some coal factory and power plant, but they are also heavily investing in wind solar firm. So you can see that in the future, they will be leaders in technologies. It is already somehow the case on the IT sectors, right? The US-based companies are heavily challenged. TikTok is one of them. So even if China is not ready yet, they are in good space to be the front runner in the ESG space as well, because they don't plan to invest heavily on coal. They have no choice, right? They are heavily investing in other technology, but they have a huge demand in electricity. If we are starting in Europe to build coal, it will be difficult now because we are putting in place some constraint about the capital availability. This is concrete. Every asset manager saying we are phasing out coal. If any energy supplier is coming to us and say, oh, we have an idea to implement coal in Poland, no, sorry, you are on our blacklist. We won't invest in you. You won't have access to any further capital. So it's a concrete example. It goes beyond just saving energy, right? And on a day-to-day basis, I would say, will you buy any new plasma or LCD screen which is rated G? No, you will look to the B, the C, the D, but probably not the G. So everyone is now looking at all those ratings for energy efficiency, right? Whether it is for the car, whether it is for the TV, it's even available for chicken. I discovered this weekend. There is a scale A, B, C, D. It's taking care of of chickens through the life cycle. So no, it's a global trend. It's impacting us very shortly, massively. So it's not about adaptation. It's about commitment to it.
Yes, sure. Yeah, it was about energetic transition. So we're just keeping rolling the snowball. um, what do you think that events in the Ukraine and the fact that we need to have a plan to quick start our energetic transition, do you think it's gonna work? If there are moves, but is something gonna change? Because we are there, but I think we need to be running faster.
I mean, certainly, and this is to make the link with the previous questions as well, is that I think the financial materiality of ESG is increasing. So in other words, the correlation of ESG and financial metrics or risks is increasing. It has been increasing over the recent years. It will continue to increase. And here we are seeing in a dramatic and almost immediate way the fact that we have a very strong dependency, we collectively in Europe, talking from that perspective, Germany being in a bad position because the decision that they made to get out of nuclear a few years ago. But we have a strong dependency onto imported fossil fuels, oil and gas. And we would like not to have that dependency, not only for climate change reasons, which its effects are being more and more felt and time is running out to change out of it, but even for immediate effects that we would like just to stop giving money to Russians and importing that gas. But we cannot do it immediately, or at least our politics have not made the decision to immediately stop the imports, because this would hurt our economy, which still needs that cheap energy. I'm sure others have also comments on this.
I mean, I think the war in Ukraine has brought geopolitics into ESG in a very interesting way, and no one has thought about it.
Thanks. So on my side, I would say that it helps to take conscious of the situations, right? So I think that President Macron started to just before with his 2030 objective by launching new nuclear plan. I think now everyone has this in mind in Europe, that we need to find solution to be independent from other countries which are not from the European Union. More specifically, it is the case for oil and cars. It is the case for coal. It is the case now also for the gas, right? So it's just helping to it will accelerate the trend, definitely. So maybe it will, during the interim period for a full clean energy, will leverage the nuclear facilities, but it's definitely helping and supporting more investment into that area, which is whether wind or solar farm.
I wanted to ask about the convergence issue and the, I think somebody was saying that, well, you know, it makes for a horse race that people have different outlooks and things like that. But in whether it's credit risk or equity analysis, there are classically things that aren't stochastic. They're just a bunch of ratios. And then you can have z-scores, and you can. And wouldn't it make sense that there'd be standards for ESG evaluation, whether a given analyst wants to incorporate them or not in her assessment? Doesn't mean that it's not you know, you see the formula that was used. Wouldn't it make the job much more transparent? And I know everybody wants transparency. You could say, this is how it's scored. Obviously in Amazon is super complex. Maybe you can't break it all out, but I would think that there should be a big push for standards. And, you know, I don't see why it's even controversial.
The convergence of standards doesn't mean the convergence of opinions. And that is important. I think that more and more ESG, which is still today very much about, you know, getting the right data, making sure your data is correct, making sure you've captured all of the risks. A lot of new risks are emerging. Is going to turn more and more into perspective, into opinions about the future. What are going to be the new risks are going to emerge? What are going to be the ones that are going to become more material? And how companies, how the environment will adapt, and which are the ones which are the most important to me. But there is one area that we were mentioning earlier of convergence where I think this is going to happen, which is integration of ESG into, you were mentioning z-scores or credit analysis in general. There may be different ways of doing it, but there will be some convergence of that, because you will see what matters in the end into predicting the default. So you have a common metric, and you start from a framework that has been standardized over the last decades already of what is credit analysis. You know, you can use different ratios, but everybody is going to use at some point some ratios of profitability, some ratios of debt, some and some other.
Some analysts will say buy with those same ratios, and others will say sell. So you still have a difference of opinion, but you'll have a common way of saying this
exactly
means this. This means that it's risk because management's not transparent.
Yes, but you may have indeed different opinions onto the risk reward and pricing, but even without going there, even just staying purely onto the risk side, it starts with a common set, a common framework. And what is happening at the international level, but also in Europe has been ahead of the game there, though probably Asia and China will catch up at some point, as was mentioning earlier, has been setting a number of standards. And the CSRD, which is going to mandate all companies in Europe, starting with the largest, but gradually going larger and larger to encompass 2 million companies in Europe, will define some of that standard in terms of data. and therefore will create a common basis onto which there can be also standards in terms of the taxonomy at the moment on the environment, but there will also be a social taxonomy that are providing a common language. Other works are being done at the international level as well. So I think we will see some convergence in terms of the framework, the language that the people talk, and then there will still be differences in opinions, and hopefully not everybody will have the same opinion, because then we will be back to the efficient market, for which then there is no opportunity for investors such as Thomas.
I believe that in that area, we will struggling a lot, right? My conviction is we are in the pathway to achieve it, but it won't be through ESG per se or rating per se. It will be done through KPIs. We are starting with the stress test, for instance, because there is different countries, so meaning different regulations, different habits in terms of disclosure and etc. So assessing a social pillar or social dimensions is not easy. But if we look at the environmental pillar, it's far more easier now. We have some information from a good quality, let's say, but we are still facing some challenges even on that data. We can perform some stress tests. We are able to do it with simple computation. That's done deal. But when we look at the carbon intensity, for instance, we have a lag of 18 months, basically, right? We are not relying on reliable or audited data, right? So it's still a challenge, but we can start to assess and perform some stress tests, whether it is by sectors, which one are exposed to the coal, for instance, and what does it mean in terms of revenue share? What will be the impact if tomorrow we have a stringent more regulation on emissions? This kind of assessment, we can make them, and it is a starting point in assessing ESG somehow. But I don't believe that we will be ready in 5 years to perform like an ESG stress test per se, but on some factors. We are working on those kind of topics. We have a department for that, looking at all those financial assumptions, and they are trying to assess the ESG risk premia. This is heavily complex due to the timeliness and the quality of data and all the jurisdictions which are very different just on the social dimension. I ran out of time, sorry.
On the topic of indicators based on quality and depth of questions and the extensive responses provided by speakers and the fact that you're all here captive, I think from the indicator perspective, you've probably gone above 90%. Thank you once again. I wanted to thank them at Pascal and the side to thank you once again, and those executives for providing this facility as well as which naturally I think will be out. Thanks again, and of course, any questions, please are on over glass. Thank you again. Thank you. Thank you.